Hello everyone, this is David coming to you from the great state of Texas. My goal is to bring to you my passion for the world of investing so that you can take control of your finances. Today, in part 4 of a series on bonds, we will review the fascinating relationship between bond prices and prevailing interest rates in the marketplace. This segment is brief, but it is one of the most important concepts to grasp about bonds. I suspect that in the future, if you get into a conversation about bonds, you're going to probably think back on this video. And here's the topic that we're going to cover today. In essence, bond values and interest rates have an inverse relationship. They move opposite of each other. This relationship is simple to grasp, but it is often overlooked when one is contemplating investing in bonds anytime in the near future. When the United States is in an environment of increasing interest rates, then the existing bonds in one's portfolio are decreasing in value. And if the economy is in an extended period of increasing rates, then those bonds in an existing portfolio are going to continue to drop as long as the interest rates keep going up. This is a bad thing, and this is not a situation that we want to find ourselves in. Conversely, if we find ourselves in a situation where we're in a long-term environment of decreasing rates, then our existing bonds in our portfolio are going to continue to rise for that entire time. Please take a moment to review this equation. Don't memorize it, just take it in and appreciate it for its mathematical symmetry. It doesn't have the universal impact or elegance of Einstein's E equals mc squared, but in the realm of fixed income, it is one of the most fundamental and essential tools. This is the equation to calculate the value or the price of a bond. It provides the basis for understanding the fair value of a bond during its life cycle. This equation adds all of the interest payments that will be received in the future for the life of the bond, represented by C, or the periodic coupon payment. If the bond has a 5-year maturity, then N will be equal to 5, and the interest payments will be summed for 5 periods. Then with this equation, we're going to add the principal payment that will be received in the future when the bond matures, which is represented by the letter F for the face value. Since these amounts will be received in the future, the divisor for this equation will calculate what each component is worth in today's dollars. In other words, these future earnings are discounted back to today's dollars. So we know what the principal payment will be when the bond matures because it is face value of the bond, and we know what the sum of the interest payments will be over the life of the bond by simply multiplying the face value times the stated coupon rate. And that's it. The sum of the current value of the future interest payments plus the current value of the future principal payments. You might have noticed this R in the divisor for both the coupon interest payments and the principal value payments. This is the interest rate used to discount these values from the future back to the present. R serves as a critical factor for this calculation in determining how much future payments from the bond are worth today, helping investors assess whether a bond is priced fairly in the marketplace. Investors look at prevailing interest rates for similar bonds in terms of credit, quality, and maturity for the R value. If we want to know the current value of an existing U.S. Treasury bond, for example, we need to determine what the current yield is for new 5-year bonds coming onto the marketplace being sold. If the intended bond investment is a corporate bond or a municipal bond, then this R value is determined by using the treasury rates as a starting point and then adjusting the R value to account for more risk. Now, there's more to be said about this and talked about when it comes to the determination of the R value, but that is a topic for another time. You certainly don't need to know how to use this equation. I am using it here for a visualization that the interest rates are on the bottom of this equation in the divisor. As we all learned in grammar school math, dividing by a larger number makes the answer smaller, and dividing by a smaller number makes the answer larger. Thus, the inverse relationship.
Wish I had a sixth-grade education.
In summary, we are using this formula to determine the fair value of a bond based on its future cash flows, helping investors make informed decisions on bond investments. So let's do a sample calculation using the equation to drive home this point. Let's use the bond pricing equation and calculate the price of a 10-year U.S. Treasury bond for 3 different interest rates. Across the top on this table, we have illustrated the main components of the bond price calculation. F is the face value of the bond when the bond is issued, and it is the amount to be paid to the investor upon the maturity date. N is the number of periods that interest will be paid until the maturity date. In this case, we are assuming a 10-year bond with annual interest payments of 4%, which is the stated coupon rate. The coupon payment is the dollar amount that is paid in interest for each period. And the column R represents the prevailing or current interest rate in the bond market for similar 10-year U.S. Treasury bonds. Now let's say I own this $10,000 bond with a coupon rate of 4%, and the current market rate for a new 10-year bonds coming onto the market is 4%. For this situation, the current price for my bond is $10,000. Now let's say that the interest rate for new 10-year bonds hitting the market drops to 3.75%. Using the bond pricing equation, my bond has now increased in value to $10,217 because I have a bond. I have possession of a bond that is paying a higher interest rate than the prevailing market rate. Now, if market interest rates increase to 4.25%, then the value of my bond decreases in value because I'm now have invested in a bond that is paying a coupon rate that is lower than what can be purchased in the bond market. And lastly, we have a visual representation of the inverse relationship between bonds and interest rates. As the prevailing market interest rate increases, the price of bonds decrease. But as interest rates drop, the value of our bonds goes up. So in the future, if your advisor recommends investing in bonds, he or she should be able to clearly articulate why the timing is right for a bond investment, and that talk should include some discussion about the current forecast for future interest rates. If you do find yourself in a situation with your bond prices in your portfolio decreasing uncomfortably, remember you can always hold your bonds until maturity and then receive back your original principal. But if you're in a long-term trend of increasing rates, your bonds are going to continue to drop for that entire time, as we've discussed. And you are going to find yourself in a very uncomfortable situation for one primary reason. And that is, all the time that you're waiting for your bonds to mature, you could have had that investment into another type of investment that was paying you a better performance or a better return. And that's called the opportunity risk. And we've talked about that in some previous videos. And that is why it is important to understand your investment goals and to understand the interest rate environment prior to making a decision to invest into bonds. Now, as a potential bond investor, you'll never have to use the equation that we've reviewed here today. But now you will understand the relationship between bond prices and interest rates.
It is a mathematical certainty.